Good afternoon, everyone. I, Sneha, on behalf of NEN and Wadhwani Foundation, would like to invite you all for this webinar and also introduce our expert, Mr. Murli Rajgopal. He is the Vice President at Unifi Capital, a management graduate from the Asian Institute of Management, Manila. He has more than 16 years of experience in the field of corporate finance. He has worked in various capacities, initially with Alpic Finance Ltd and NBFC, and thereafter with Navia Markets Ltd, a Chennai-based NSE member. His functions in these companies included client sourcing, credit evaluation, transaction structuring and completion, private placement of debt or equity, identification of potential investors, and post-transaction services. Before I hand over the floor to Murli, here are a few reminders for the audience. You will all be on mute. You may ask questions by typing in the panel provided. Over to you, Murli.
Thank you, Sneha. Good evening, everybody. I'll just before I get into the actual presentation, I would like to explain to you how I'm planning to go ahead with the presentation. I'm considering the fact that all of you are primarily decision makers. The focus of my presentation will be in terms of how, as decision makers, you should evaluate the profit and loss account, the balance sheet, and the cash flow statements, which are prepared by your accounts team or your finance team. The focus will also be in trying to help you to focus on specific issues, on specific numbers, which will be necessary for you in terms of running your business, both at a strategic level, that is looking to creating value for your business over a long-term period, and also at an operational level when you're running the business on a day-to-day basis. And as entrepreneurs and your budding entrepreneurs, I presume that you will be actually doubling up as your finance head, because you will most of your team will consist of people who are accounts specific, that is, they record information. But the analytical part, the analysis part, will be completely your responsibility. So based on these presumptions, I shall go ahead with my presentation. My presentation is structured as follows. I'll be focusing on the three general statements which are prepared, which is the profit and loss account, the balance sheet, and the cash flow statement. Under each of these statements, I shall focus on specific items which I think are important for you to keep in mind. Obviously, once I complete the presentation and when the question and answer session begins, you are most welcome to ask questions in elaboration of what I said, or completely, even if it includes issues which I had not covered in my presentation. You're most welcome to ask questions at that point of time. So now let me start with the actual presentation. I shall first focus on the profit and loss account. As you're aware, profit and loss account is basically a statement which records the revenue and the various costs incurred by the business. But within that, what are the items you should focus on? The first area is, of course, the first item, the item is the most important, the revenue item. The revenue there, of course, as the very term explains, it is basically the recording of your sales. You have to, this is important. And when you are looking at when you look at a revenue figure, I presume you'll be looking at revenue figures, say, every quarter, just as an example. Then you should look at the revenue figure in two ways. One, you should look at in absolute numbers what has been achieved, and the other aspect is you should also analyze it with the previous quarter's performance. The reason for this, it gives you a sense. It gives you not necessarily a perfect sense, but gives you a sense of how your business is growing, whether your business is growing, and if so, at what levels. It also, you should analyze your revenues under two aspects. A, in terms of customers acquired. Two, in terms of the price of your product. That is, you should ask yourself at what what average price are you selling your product and service compared to, say, the previous quarter, and also in what number of customers have you acquired between the 2 quarters. By the way, quarter is just an example. You could do this month-wise also. This will give you, I mean, as real, you will be surprised when these numbers are, which look so simple, that when you direct your focus on these numbers, it brings you a sense of where you're going. It will give you a sense of how strong your sales processes are, how strong your product offering is with respect to your customers, and what price points your product is being sold to the customer. Then once you, after the revenue is, after you have analyzed the revenue, there is something which is called COGS, or the acronym, or it's an acronym for the term cost of goods sold. This is basically, in very simple terms, trying to analyze all the direct costs which are involved in getting your revenues. Very simple. That is, you have a product or a service. What are the costs which you can directly attribute for delivering your service or in creating the product? You must be careful that you correctly identify these costs, and also you must be careful that you identify all the relevant costs. This is very, very important. Once you have identified this cost of goods sold, you remove it from your revenues to analyze how much, after all the costs which are directly involved with your product or service, how much money is left with you. That is, if you sell for 100 rupees, if you sell for 1 rupee, if your cost of goods is 60 paisa, in other words, you are saying, I have got 40 paisa after I have paid for all the direct costs which are involved in the for building my product or service. Once you have, so we call the term which we call is this, is the gross profit or the gross margin. That is, after all the direct costs are removed, what is remaining is the gross profit. And this is important, very important. In other words, you're saying for every rupee of revenue, after you have eliminated your direct costs, how much are you earning? The higher the gross margin, as you will understand intuitively, higher the gross profit margin, the better for the business. What it basically says, or at least sends a message, that you have strong pricing power. That is, either you run a very efficient business such that after your direct costs are removed, you have more money, you have sufficiently higher money to spend for other expenses. But one thing you must keep in mind, if the gross profit margin is negative, that means you are in trouble. That means, in other words, you are selling your product below your direct costs, and that is definitely not sustainable for most businesses. That fundamental message, you must keep it in mind. So once you have crossed the threshold of the gross profit, the gross margins, and you have arrived at that, then you look at all other costs. Every business will have other costs, like other set of, you will have employee costs other than what was required for directly producing your product. That is, you'll have administration, you'll have your marketing costs, you'll have rental costs, electricity, travel. So all this, from where is it going to be paid? It's going to be paid from your gross profit. That is very important. So now you'll be able to appreciate the fact that higher the gross profit, you have greater buffer to pay your operating costs. In this context, you come to the term EBITDA. In other words, once from your gross profit, after you remove all your operating costs, and operating costs are costs which are not direct to the delivery of your product, but are directly involved with regard to your business. Those costs, when you remove it, you come with something called EBITDA. That will give you the money which the business, this is a very important figure. What it tells you is, after all the key costs of the business are paid, how much does the business earn? Because I'm sure every one of you who's an entrepreneur is here for a profit. That is what it is. That is, at an operating level, after you finish all your expenses, if you're left with any money, that is earnings before interest, depreciation, and tax. After this, there are two items. So, no, I'll just continue being in the term EBITDA. What EBITDA gives you a sense of the direction of your company. If EBITDA is low or close to zero, you realize that your company, you are either having very high costs such that you have to reduce the costs so that you can increase your EBITDA. Otherwise, you have to increase your gross margins. Of course, it's easier said than done. It's not so simple, but it makes you then reflect from a strategic level how you have to position and improve your business such that you can achieve this. Keep that in mind. All these terms, all these metrics are sending you a signal from a strategic perspective and from an operating perspective. Then you come to something called interest. This is an item which basically says, in case you have borrowed money from somebody, and then for that either from a bank or you're taken a loan, the interest for that is the cost of the debt which is reflected as interest is involved in this, and this is paid from that EBITDA. Why this is important is there are businesses which may be at EBITDA level positive, but once the interest is paid, then they either become loss making, or their profitability is reduced significantly. At these times, it again is a signal to you that either you are borrowed more than what you can chew, or the cost of your debt is very high and you must renegotiate the cost of debt. But this is something you'll have to take a call at that point of time. Then finally, of course, it is tax. I think it's self-explanatory, the income tax which any company has to pay, and post which is the profit which is available to be divided among the owners of the company. Let me now take you just as an example how each of these items impact you. Just let us look at this sheet. Let us say I'm assuming revenues are 100, your direct costs, which are production costs, are 40, and other direct costs are 30. So your cost of goods sold is 40 plus 30, which is 70. Your gross profit is 100 minus 70, which is 30. Just see how this can change. At 30 rupees, you're operating at a gross margin level of 30%. But let us now make a small change here. Let us say your costs become 60. Your production cost becomes 60. Please see the immediate impact. Your gross margins have come to 10%. And now at 10%, now just let us keep this at 10% and see what happens. Your gross margins are 10%. Let us see, now we go to your operating costs. 10 rupees, employee costs, rental costs, 2 rupees, travel admin, total operating cost is 32. Your EBITDA is minus 22. In other words, your business has not earned sufficiently to pay for your operating costs. So you have only two choices. Either you reduce all your operating costs to less than 10, or you increase this 10. You have just two choices, and that is what you'll have to make. Either, let us say, for example, what I mean by reducing your costs. got it? Look at the costs I have to reduce, but it's easy to do in an Excel spreadsheet. But in real life, can you actually reduce it? Can you, if you reduce your employee cost like this, will your employees be with you? If you reduce your rental, your landlord will kick you out. So it is not that simple to reduce these costs. There are some costs where you have control over, some you don't have control over. So keep that in mind. But the reason I'm just showing this as an extreme case is just to tell you the importance of gross margins. That is, for every 1 rupee of revenue, the higher the margin you earn, the better off you are in terms of running your business. Just keep it as a thumb rule. See, EBITDA is here 0. EBITDA 0, margins. Then just look. I told you after your operating expenses. Even here, if you have just achieved this, you got your interest, which is 1 rupee. You got your PBT before tax, which is -4. Once again, you're a loss-making company. Yeah. So the question here is, as I told you, is keep your gross profits as high as possible. So let us now bring this gross profit. This gross profit, say, back to a more respectable figure. Okay. So here your gross margin is 40%, and increasing your marketing costs, your employee costs. So you made a 24%. You have made a 24% operating margin. You paid your interest. You've got PBT. You've got tax. You've made a profit. But I also want to expose you to one more concept, and that is called cash profit. Just let me just change the format of this cell for a moment. See, as a decision maker, you're not just looking at profits alone. You're also looking at something called how much actually cash you have in the system. In that context, I want to talk about a term which I did not talk earlier. That is depreciation. I think most of you are aware about it. In the balance sheet, you have something. You buy assets in your business. You buy plant and machinery, or you buy something for which there is a concept of depreciation. And depreciation has once you buy the machines, that's the only time you pay the supplier, and it ends, the story ends. Depreciation is something which you put it into your profit and loss account because you get a tax benefit. That is, the income tax authorities allow you to deduct depreciation before paying tax. But it's a non-cash item. So look at this. You are at you have something called here, profit is about 13.6. But actually, you have got more than 13.6 in terms of cash. I think I got the formula wrong. I'll just correct it. Yeah. See here, what you're seeing is why this is important is that profit is 13.6, but actually you have more cash in your system. What I have done is 13.6 plus depreciation. So because it's a non-cash, so keep that in mind, because when you want to get a sense about how much money is there within the system, you must include this depreciation also, which gives you a higher amount than what is actually reflected in the profit and loss account. So keep that in mind. Concept of cash profit, you call it. So, and the other aspect, there's one more term which I wanted to bring, a concept which I wanted to discuss with you is break even. See, again, you are entrepreneurs. You're going to be, and I'm assuming that you're all budding entrepreneurs. You've just set up your businesses, and so it's very essential. And when businesses are set, I've seen in my experience, challenges in the first 2 years, first 2 to 3 years to establish yourself. And during that time, one of your primary goals is, you will understand, is to break even. What does it mean? Very simple. It means that your revenue should be at least equal to your costs, all your costs. That is, if this is 100, all your other costs, such that this PAT should at least be 0. In other words, your business should reach that level which is sufficient to, you are able to earn sufficient revenues to pay off all your costs. That is itself one of the first milestones for any business. And so keep that in mind. Keep that in mind when you're running. That is, why is it important? It's not just as a concept. You will, when you will focus on seeing here in the revenue to get customers how much units you must sell and what price you must sell, because you know your costs. Okay, so you can work backwards to get a sense of at least what is the minimum number of units do I have to sell at a prevailing price. So it really focuses, always you will be focused on seeing either you increase the number of units and lower the price, because if you feel the customer will come at a lower price, then obviously you have to sell more number of units. So this is a very, very active metric. Keep it in mind. It's not a simple mathematical one. It will force you to think through about your business, saying every time if you are facing challenges, how do I ensure that my business pays for itself? And in that context, both you will focus on your revenues in terms of customers, in terms of pricing, and also you will focus on trying to run your business as efficiently as possible. You will keep saying, you will try to focus on saying, how much of expenses do I need these expenses? Can I reduce it? Can I run more efficiently? That will always be your focus. So you understand what I'm saying? Focus on revenue. From a break-even viewpoint, to achieve break-even, you have to get a sense of how your pricing strategy and your production, the units, what you have to sell, and from a cost perspective, how efficiently you can run your business. These will be the two factors which will be vital for you when you are evaluating a business from a break-even basis. So please remember, these are not simple numbers. These are all linked to your business. In the sense, for you as a decision maker, when you see this, you should start thinking, if you're running a lower gross margin, how do I improve my gross margin? If you're running a lower EBITDA, how do I improve my EBITDA margins? That must be your focus. Remember that. So see this as don't see these numbers as static. See them as live numbers, numbers which force you to introspect and make changes in your business. So this ends my presentation on profit and loss account. Now I shall go to the balance sheet. Okay. As again, I repeat, as a decision maker, remember that you're not accounts guys or something. I'm talking to you, assuming that you all take decisions with regard to your business. First is the capital structure. What does this capital structure mean? It's very simple. I'm sure you guys will know it already. It is saying, how do I fund my business? That is, your business, every business requires money in the beginning itself. So that money, from where will it come? You have only two ways to get it. One is equity, and the other is debt. You remember that when we were doing the profit and loss account, we were talking of interest. So that is connected with debt, as you're already aware. So the question is, it's very necessary for businesses to get a right mix of equity and debt. But frankly, many of your businesses, what I've been given to understand, are evolving businesses. Actually, debt is quite difficult. At least to get debt from banks, it is a challenge. Though frankly, there are some banks like State Bank of India and all which have a SME segment. So maybe they are more open to looking at debt from companies like you. But always I've noticed for smaller companies debt is a challenge. But it is essential that every business must be funded by equity and also preferably debt. But the mix has to be, you have to get it right. And that mix is concerned with two aspects. With regard to debt, you have to be careful how much debt you take, because it's not only paying the debt off, but paying the cost of debt, which is interest. So that is a function of how much business how can you do. Again, let us go back to that earlier discussion we had about P&L. This is the key issue, your EBITDA, your operating margin. How much margins you can build in your business, because only from here you're going to pay your interest. Remember that. And higher your margins, you have more buffer to pay the interest. But also it is linked with one more thing, is variability. How variable is your business? How sure you are about your revenues? Because if the revenues are not there is always the uncertainty about your revenues. If they are higher, then you've got to be careful, because when at that point, if there is a drop in the revenues, your EBITDA itself will drop, and then you won't have sufficient money to pay for interest. So you as a decision maker, you will have to make the right judgment about how much debt you can take, keep in account your EBITDA margins and also the degree of certainty about your revenue. So this is with regard to the capital structure. Second is working capital. Oh, this is so important for businesses like you. It is worthwhile to understand what is this working capital. Working capital is basically the assets you have which are required for the day-to-day running of the business. It usually is a combination of inventory, sundry debtors, cash, and something called advance and deposits. That is, these advance and deposits are usually rental deposits, electricity deposits, deposits with your customers you have to give if they ask you. And so, in other words, this is the figure. This is the current assets. Why this is important is all these are money which is locked in. So the key is how to unlock this. So inventory, if you have it in raw materials, the challenge is how fast you can convert it to your product, which in turn you can sell. So the faster you are able to do it, the faster you are able to convert it to cash. So all this you have to convert it to cash. What is sundry debtors? If you have a credit policy, if you are selling on credit, then the question is at what sort of credit policy are you giving to your customers? The faster you're able to get your money from the customers, the better for you. This is again, what I'm saying is not rocket science, it's all intuitive. You get back the cash. But the challenge for any person is how to manage this, because your cash is being locked into these two, especially inventory and sundry debtors. So this is where usually what companies do, either if they have very high margins, what happens is they are able to earn a lot of cash and they are able to fund this themselves. Otherwise, if they have to go for something called a working capital loan, and this too is funded by either through a loan from a bank and through current liabilities. That is, you have payments to your suppliers, you ask for credit terms from them. So the best business is if you're able to match your current assets and current liabilities. So in other words, what you have to collect and what you have to pay. But in real life, very rarely that happens. Usually, you have to pay your suppliers earlier than what you can receive. But the challenge is for you to manage, because if money gets locked in, you don't, even if you have a very high P&L, again let's go back here. If you have this, what you call, you have this, say 24% operating margin, that's a very good margin. But what is the use if this 50% of that, say of this revenues is in credit? That means technically you may be earning 24%, 24 rupees, but but 50 rupees is already locked in. Say 50% of this, if I say 50% of this is locked in terms of payments to be received from your customers. So that 24 is actually illusory because it's already locked, it is lying with your customer. So you can appreciate that it is imperative that you must be able to get back the money from your customers as quickly as possible. You got it? See here. That is, this is your sundry debtors, 50 rupees. 100 you sold, 50 it's locked in. And here you are making a profit of 24. But what is the use of this 24? Because it is all here. It's all locked in. That is 12 rupees is locked in. That is, you got it. For 100 rupees you earn 24, so 50 rupees is sundry debtors, 50 into 24%, which is your 15 to 24%, which is your EBITDA margin. That is locked in. So that is, let's do it here so that to show you what it means. So this 12 rupees. So this 12 out of this 24 rupees, 12 rupees is actually locked in. You don't have that profit. You just remember that. So it is very important for you to manage your working capital. Just remember that. And what is working capital? That is, it is this total current assets, okay? Minus that means this 37 rupees you require, you will have to manage, because out of this 53 you will have your current liabilities which you have to pay your suppliers, and you're left with about 37 rupees which you'll have to get financed. And this has to be financed, remember that, because this 37 is locked in. It is something which is not there in the system. This cash is not available. So your challenge is to fund this, at the same time ensure that as quickly as possible you're able to convert this and this into cash. Remember that. That's what it means. Keep a very, very tight watch on your current life, on your working capital. That is, keep a watch on your current assets, because what people do is they sometimes try to, if they don't get the money, they delay paying their suppliers. But that is not a good idea, because if you stop paying your suppliers or delay, then they will not give you good credit terms. They will charge you higher for that, because nobody is going to give you free. And that, if they charge you higher, your profits eventually will come down. So you notice all this is interconnected. It's all not, all these items are interconnected. So as a decision maker, you must keep an absolutely focused, I mean, I cannot emphasize it. There, no emphasis will be too much, because the biggest of organizations have paid the penalty of not managing their working capital. So keep a very, very strong watch on your working capital. The last is, of course, ROE. I presume you're all shareholders in your company. You're all shareholders of your company, either 100% or combined with your relatives and friends, you must be 100% owner. This is what you're working for, actually. That is, you are saying that this is my equity. This is the equity I pumped into the business. how much is the return after paying for all expenses, including interest and tax. In other words, you're saying, the more I'm able to maximize the return, the better it is for me as a shareholder. Let's just do some numbers here. Your profit after tax divided by return. %. So in other words, what you are saying is basically, for every rupee I invest, I get 18% from my business. It's a little crude way of saying it, but that's what it is, return on equity. So you can appreciate the fact that better you're able to improve this rate, the better it is for your business. For not your business, for yourself, for the shareholder. This is after all, this is what you're working for. You are working to improve this. Remember that. That is your challenge finally. I think if you just keep this number in perspective and then you work backwards, you'll have absolute laser clarity about your business, in the sense what all you have to do to improve this number. But keep one aspect in mind. In the name of improving this number, don't cut certain costs which are important for you as a business strategically. Remember that. That is, when I mean strategically, that is, they have long-term impact. So some companies, in the name of improving shareholders, I'm telling you at an extreme level, there are some companies which have cut their research and development costs because it improves, at least in the short term, their return on equity. But that is illusory and that is very short-termish, because if you cut down in R&D, then your ability to produce newer and better products comes down, and then your ability to compete in the marketplace becomes much more difficult in the long term. So keep that in mind. In the name of improving your return on equity, don't do things which negatively impact the business in the long term. So in this I now complete my presentation on the balance sheet. Now we'll go to the cash flow. The cash flow statement, as I presume you must be aware, is a derived statement. That is, it derives from the profit and loss account and the balance sheet of a business. What is the importance of cash flow statement? Have you heard of a term? You might have heard of a term called cash is king. What it basically means is finally how much cash is there in the business. How much cash does the business earn? There is all this profit and all that is fine, but does it result into cash? Because without cash, there is no business at all. Remember that. These are all actually fundamental concepts, but you'll be surprised many of us forget that. So keep that. I think it may be even worthwhile if in front of your table or something, you just keep the statement cash is king. It will, I think, really focus your thinking whenever you take any decisions with regard to your business. So let us understand how you should interpret the cash flow statement. You remember this is 13.6 where it came from? It came from this P&L, where the profit after tax. So you have 13.6, great. Then you have the depreciation. You remember I said about this thing, depreciation being a non-cash item. So again we take depreciation 3. But then we come to something called changes in working capital. What does it mean? What it means is just one second. Yeah. it's basically saying that this the advance and deposits, your sundry debtors, and your what do you call your inventory. How much money have you invested for this year? That is what it means. Let's see. C33 plus C31 plus C30 minus C20. Let's just see that. What is C33? C33 is advance and deposits. C31 is 8 and inventory is 6. Okay. So you add these three and then you minus this C20. What is C20? Your current liabilities. So in other words, what you are saying is, I told you, your current assets minus current liabilities. That is, you have to invest 8.2 in your working capital. So in other words, look at the cash now. Just look at the cash. You have 13.6, which is your profit. You're adding your depreciation, so 16.6. But you have made investments in your working capital, which is 8.2. This is called, by the way, net current assets, to be precise. You're invested in your net current assets after deducting your current liability. See, it's 8.4. That is what you have in terms of cash. And let us assume that you are purchasing some fixed assets. Okay. I'm assuming you're purchasing a fixed asset for your purchase, which is about 70. Okay. And you have spent 670 for your, then you have raised equity of 60, you have raised debt of 30. So 90 rupees you have raised in terms of equity and debt. You remember I had spoken about capital structure. This 70 is the asset you are spending. So how much is the cash you have? You have something called 28.4. How did this come? That is, you just can add it up here. From your operations, you earned 8.4. That is from your business. Then you have raised 90, which from equity and debt. So 90 plus 8.4 is the money which has come into the business. Out of that, for your fixed assets, you have spent 70. So the balance is 28.4. Just remember how you should see it. You are saying you have to, when you must focus your business such that it reaches a stage where from here itself you are able to generate sufficient cash to pay for any such investments. Because the more you keep borrowing or you take more capital, in both aspects, it is negative after some time. That is, if you raise more debt, what happens? You will have to pay more interest and your profit margins will come down. And if you raise more equity, what will happen? You remember I spoke of a term called return on equity? So now the denominator of the equity is becoming increased. So you have to earn more profits just to maintain the same margins. I told you last time I showed you made a return on equity of 18%. But if you increase your denominator, you will have to improve your numerator such that you maintain your 18%. And that can be quite challenging. So it's a good business should reach a stage where it's not, except for working capital, it should not depend upon equity or debt. But that will take some time. It's not easy. When businesses are growing, they need money. I just want you to keep in mind. But what at least keep in mind is this is an important figure to tell you whether your business is generating cash. Let me show you. Instead of this working capital of 8.2, let us make it 14. Not even 14. Let us make it 18. You got it? If you have invested more in your working capital, even if your profit and loss account shows you're profitable, but this tells you that your business itself is not generating cash. It is not generating cash because money is getting locked into working capital. So keep that in mind. No? Always keep this issue in mind. It is not enough to look only at the P&L. The P&L sometimes can be, the profits shown in the P&L can be very illusory. Because when you look at the cash flow, and the cash flow shows that actually the business is not generating cash because the money is locked in. And why it's locked in? let's say working capital, if you're putting 18, that means maybe your customers are not paying you. So in your profit and loss, you would have shown those customers as revenues. So you're showing a lovely profit. But when they're not paying, then what is the use? So do you understand what I'm saying? I think now you can better understand that term called cash is king. That is what it means. Be very focused on this figure. Is my business actually generating cash? So this ends my presentation on the 3 statements, and now I'm open for any questions if you may have. Thank you.
Thank you, Murli. We'll start with the Q&A. We have the first question from Alpic Jain, and he says,
okay.
Is the salary of sales people included in COGS or in operating cost?
It's a good question. Usually the salary of salespeople are included in costs, not at COGS. Not at the COGS level, but at the cost level. That is this one. Here. Usually it's included there. But yeah, that's what it is. Hello? Hello? Hello?
Hello?
Can you hear me?
Yeah,
can you hear me?
Yeah, we can hear you.
Yeah, I sort of lost you guys. So what I'm saying is, sales employee, you usually put it here, below COGS, not as part of COGS.
Our next question is from Supriti Tripathi. She asks, what is operating cost?
Okay, we are on that sheet itself. Operating cost is this is not, what I'm going to tell you today is not necessarily complete. It depends, each business has its unique costs. But at a very simple definition, you could say all costs which cannot be allocated directly in the production of your product or service can be put into under operating costs. Not a perfect definition, but that I think that can help for you to get a sense of how to allocate the costs. But usually these are the costs: marketing and sales, employees, rental, travel. Admin will consist of electricity, stationery, internet costs, telephone costs, etc.
We don't have any more questions. Are there any more questions that you want to ask? Okay, there's somebody. The questions have started coming. So this is a question from Niranjan.
Okay.
And he asked, where should I include commission or incentives on sales?
Can you repeat? What did he say? Commission on?
Where should I include commission or incentives on sales?
Okay, that's a good question. I would see, I'm not now talking from an accounting perspective, okay? I would suggest you deduct it from your revenues. Okay, so that you have no, these are directly involved in earning the revenues, the commissions. So I would suggest you reduce it from your revenues. Your accountant may say it differently, but again I'm repeating, I'm assuming you guys are all decision guys. So you say, okay, I earned revenues of 100, show it separately, but show less commission. Show that separately, but show it in a way so that you include it as part of your COGS. Hello? Hello?
Yeah, we can hear you. Hello?
Hello, did you hear me, Sneha?
Yeah, we did hear you.
It's about commission. What I said is include commission as part of COGS.
Okay.
If it's directly involved with regard to getting the sales, directly.
He's also asking in addition to that, so you mean that am I supposed to pay it in cash and not include that amount in the statement?
What is it? Should I pay it?
For the commission only, he's asking, in addition to what he asked, that do you mean that am I supposed to pay it in cash and not included in the amount statement?
No, I didn't say that. I just said include commission and show it. I said you include it as part of COGS. But however you pay it, whether cash or check, that is immaterial. No, it's part of your cost structure. That's all I'm saying. Let us put it. If he's just telling it. Am I coming clear, Sneha, on this?
Yes,
whether
you're clear now.
Whether it's cash or check, that is immaterial. The cost which is involved in getting your revenues. So show it as part of your COGS. That's all I'm saying.
Okay, I think he gets it now. Our next question is from Vipul Jain. He asks, what costs to include in COGS in case of SaaS, software as a service model?
Which one? As a
SaaS model.
Regard to?
SaaS model.
Okay. The question again is the SaaS model is with regard to the revenue. That is, I presume the SaaS model is basically saying that pay as you use. That is the principle behind it. But that is with regard to revenues. With regard to cost of goods sold, again it is the same principle. Whatever software product he's developed or he's doing, whatever costs are involved in either maintaining that product or developing that product. Basically, in his case, it will be maintenance of that product because the product will have been created and now he is allowing people to use it and pay for it as they use it. So that will come in revenues. But he will be doing a lot of work in managing and maintaining that product. I don't know, technical support or something else, server costs, because he must be keeping these, he must be placing this product in a server, the internet costs. So all those costs which are directly, you can say, are responsible for managing that product. He'll put that for COGS. So for example, I'm not too familiar with that industry. I'm assuming server costs will be there. That he should put it in COGS. Any internet costs, any telephone and telecommunication costs, all that should be included in that.
Okay. That was nice. Our next question is from Ashish. He says, how do we calculate depreciation on assets?
Okay. I would suggest Ashish, he just has to, I mean, there are various types of assets. He just has to, talk to the chartered accountant who will give him a list of assets and the depreciation rates prescribed, which is all there part of the income tax of the Companies Act. So he just, those assets and the rates are given. So he has to, whatever assets he has to look at that list, and at whatever depreciation rate it has been prescribed at, he will use that rate to come up with the depreciation. But just one thing here, it will be worthwhile for him to remember, there are two types of depreciation. One is Companies Act depreciation and other is income tax depreciation. The depreciation which is shown here, which I am showing, it is assuming that it's Companies Act. But when he pays the income tax, what happens is he's allowed to use the income tax rates for depreciation only for when he's calculating the tax. And the income tax rates are they are actually usually higher than the Company Act rates. And because it allows the taxpayer to take advantage of higher rates, because you can imagine if you do it at a higher rate, the depreciation will be higher, so there will be lesser profit, and that is lesser PBT, and your tax also will be lower. But to answer a specific question, how to calculate, he just has to ask a chartered accountant. The chartered accountant will give him a list from the Companies Act, which will give the list of assets and the depreciation rates.
Thank you, Murli. Our next question is from Prince.
Hello.
Hello.
Yes.
Prince asks, can you give some more examples where there are profits in P&L account but less profits in operational activities other than debtors?
I presume what he's saying is, he's asking, can you give other examples? In other words, he's trying to say that, I presume, I would like a clarification on that, that the P&L is showing profit, but the cash flow is showing something else. Is that what he means?
Yes.
Huh?
Yes.
Okay. Let's use this as an example. Let's use this. Let's say, for example, this operating cost is just see this. Please see the operating margin. Huh? Just see that. You see it now. It's jumped to 30%. Okay. Now let's go straight. So 30% from 24 it has jumped to 30. So PAT has jumped to 17.68. I don't know whether you remember earlier it was about 13 point something. So now let us go to the cash flow. So here he has got 17.7. Huh? Great profits. I'll just once again see the margins. Margins is 18%. 18% net margin. But just look at here. He's just got 2.7. That is because of this. 18% net margins. That is, for every 1 rupee of revenue, he is getting an income of 18 paisa. Just remember that. That is what this means. But once you include the working capital, he's actually having cash of just 2 rupees 70 paisa. From 18%, which he should have had, if actually see it's 17.7 plus 3, he should have had 20.7, but he's left only with 2.7. Why? Just because of the 18. Just understand. Just see. Let us make working capital. Let's just say 2. That is, you have invested only 2 rupees in working capital. Just look at this. It just jumps. Your cash jumps. So you can. I hope this helps him to understand how important this working capital is. How much money are you investing into your working capital? The lesser you invest, that means you're able to get, at the end of the period, you're able to get the cash from, you're able to collect the cash from your customers, and the inventory, you're carrying a very low inventory, your cash from the business improves. I'll just show you how it can change. Say 21 is your inventory. Actually, your business is not having cash. How many businesses get into this trouble? They show a great profit, but they don't have cash. Why is that? It sounds, I mean, I'm sure you find it intuitively, you can't accept it. If I'm making such a great profit, why am I not having cash in the business? That is just because of this. I hope that helps in better understanding it.
Sure, it does. Our next question is from Abhishek Thomas.
Yeah.
He says, what does an investor look for when he looks at your financials? Anything in particular?
First, he first looks at this, your gross margins. He looks at this. This is important. He really looks at this. He says, can these guys, what sort of, from their revenue, from whatever they are selling, how much money are they able to earn after they pay off all their direct costs? They higher the margin, they like the business. That is one. Please don't take, you must understand there are different factors, but this is one key factor. They look, they say, what is the COGS? COGS means, I'll just show you. %60. In other words, they'll understand if COGS is 60, your gross margin is 40. Just see this. If I make this now 80. Just watch this. Your COGS is 80. Your gross margin is, in other words, your gross margin is 20. So this is one very key figure. The second is your operating margin. That is the EBITDA margin or operating margin. How much, after paying all your costs, what sort of margins are you? But you're all evolving businesses. I'm keeping that in mind. So to tell you frankly, this is the, if any investor is looking at your type of businesses, they first look at the gross margin level. This is the key figure. And then the other figure which they look into is your working capital. Just remember your working capital, they will try to see, I explained to you in the cash flow statement itself, they will try to see how fast are you converting your inventory and sundry debtors into cash. The faster you're able to do, say, let us say you're able to show that within 1 month, you're able to convert everything into cash. That is, in other words, if you invest in inventory, in 1 month's time, you're able to sell it. There are specific ratios for that. That will I'll show it in some, I'll do it if there is another opportunity to talk to you. But just keep this in mind. And sundry debtors, you're able to show that you give 1 month's credit period and you're able to collect your cash. If you're able to show that your working capital cycle, they call it the working capital cycle, that is the money which is locked in. The time for you to convert the money which is locked in into your current assets into cash, the faster you're able to do it, they like it better. That is what they like. So to understand, keep that term, working capital cycle. What is working capital cycle? Your current assets minus current liabilities, whatever be the figure, how quickly do you convert it into cash? So does it take 1 month? Does it take 3 months? Does it take 6 months? So definitely if it's 3-4 months, they get a little worried. But if you're able to say in 1 month, 1.5 times, but that is also a function of the industry. Please keep that in mind. Some industries, the credit terms are much higher, so you can't help it. So it depends. The investor will have to keep that in mind also. But I'm just talking at a general level, what they look at. So keep these two minds, the gross margins, your working capital, and also, yes, you're working. I'm again telling you, as I'm again saying, I presume your business, my audience consists of people who are just starting their business. There are other things also people look at, but the investors who are looking at evolving businesses, they usually look at these two: your gross margins, your working capital cycle, and also one more thing. Yeah, one more thing they look at. They look at the size of your market. Okay, you earn your revenues, no? You earn your revenues because you're selling your products and services in a particular market. What is the potential size of the market? The larger the size of the market, they like it. That is better, because that means you can create value even if you get only a small percentage. Let me explain what I mean. Just think your business, your market size is 1,000 crores. Then even 1% of 1,000 crores is how much? It's about 100 crores. So, 10 crores. So even if you even if you do 5%, you will do 50 crores. So what I'm trying to convey is, the bigger the market you are, the bigger the size of your market, they find it more interesting, because you have potential to scale up even when you achieve a small penetration of the market. You understand? Even if you achieve 2% of the market, but you are able to get a revenue 2% to say 100 crores, then that means the market is huge. So that is fine with them. So to answer this question, they look at the size of the market, gross margins, and working capital cycle. That's it.
Thank you, Murli. Our next question, hello. Thank you, Murli. Next, we have the last two questions of the day. The question is from Vipul Jain. He says, are there other options in capital structure apart from equity and debt?
Not to my knowledge, in the sense, if Vipul can ask, if he can specify what he means by that, because usually there are only, at a broad level, there is only equity and debt. There are various hybrids, as they call it, which I don't want to go into it, it's a little complex. But there are very hybrid instruments. And even those hybrid instruments are basically a combination of debt and equity. So in other words, at a broad level, it's only debt and equity. And there are hybrid structures which capture the essence of both, a debt aspect also and also an equity aspect. But that is, I think, a little outside the scope of today's discussion.
Okay, and our last question is from Abhishek Thomas. He's asking, during the initial stages for business, it is difficult for the cash flow to be positive. Is this something an investor is willing to oversee?
That's a very good question, actually. He's right. Let us go to the cash flows. See, the investor will be able to, if the cash flow is negative at this point, let me explain first. Let us again make this 3. Okay? Please see here. You are buying a fixed asset. You are negative here. If you are negative here, the investor will be ready to overlook, because he'll understand. That is, you need this investment to build the business further. So he cannot expect at this point that your business should be able to generate that much of cash that it can pay for this investment. Okay, this investment. But what he'll find difficult to overlook is this: that your core business itself is not generating positive cash. In other words, your working capital is locking all this up. Unless you're able to give him a very, very valid, very convincing answer, if you're cash negative at this point, it'll be difficult. You really have to demonstrate why that is so, and it must be logical and convincing. So I hope I am answering his question. If it is negative at this level, he will definitely be ready to do it, because this is a long-term investment. But if it's negative at this level, at an operating level itself, I told you cash is key. That is, your business is not able to generate. You're locking your money somewhere. Your customers are not paying you. Inventory you're taking up, which you're not able to convert to cash. That is your core business. And if you're not able to do that, there is some problem. That is why. So this is where is my answer to his question.
Thank you so much, Murli.
Here is, yeah, sure.
So thank you very much for this very interesting session and very informative session. Thank you to all our attendees for participating in the webinar. We are glad that the questions did keep coming, but we've already exceeded the time. So you can send in your questions. We'll try to forward it to Murli. Please do send in your feedbacks and suggestions at eclub@nenglobal.org. And if you found the session interesting, please feel free to blog or post about it. The recorded version will be available to you. And you can also go to our YouTube link. It's eClub.NEN Online. And thank you once again, and have a really nice evening.
Thanks, Sneha, and thank you everybody for giving me a patient hearing when I spoke. Thank you very much.
Thank you so much. Bye-bye.